If I had to look at these four mega cap earnings today from scratch, knowing what I know about the AI spending race, the cloud land grab, the advertising rebound, and how quickly Wall Street can change its mind, I would not start with the headline beat. I would start with the thing most investors skip. What did the company have to spend to get that beat? Because that is the real story now. Amazon can beat, Microsoft can beat, Alphabet can beat, Meta can beat, and still, one stock barely moves, one stock gets questioned, one stock gets rewarded, and one stock drops hard enough to make everybody suddenly ask whether the AI boom is turning into an AI bill. Today is Thursday, April 30th, New York time. Comment below what day and date you're watching from, because these earnings reactions can change by the time the regular session opens. And if you value my content, support the channel by subscribing and comment John AG Best below. So let's get into it. We are not going to treat this like a scoreboard, where beat means good and down means bad. That is beginner thinking. The market is more annoying than that. The market asks, was the growth high quality? Was the profit repeatable? Was the spending controlled? And most importantly, is the stock price already assuming everything goes right? That is where this quarter gets interesting. Start with Amazon. On the surface, Amazon delivered a very strong report. Based on recently published numbers, sales moved to a little over $180 billion, up in the high teens from last year. North America grew in the low double digits. International grew even faster on the reported number. In AWS, the cloud engine everybody watches, grew in the high 20s to almost $38 billion. That is not small company growth. That is huge company growth on a giant base. And AWS operating income came in a little above $14 billion, up from the low $11 billion range a year ago. That tells you the cloud business is not just getting bigger, it is still producing serious profit. But here is the part you cannot ignore. Amazon's net income also included a very large pre-tax gain tied to its Anthropic investment. That does not make the quarter fake. It does not make the company weak. But it means you have to separate the operating engine from the accounting boost. And this is why a stock can have a massive earnings headline and still not explode after hours. Investors are not stupid. Well, some are, but the market as a whole usually asks the second question. What part of this happens again next quarter? Amazon is spending aggressively on artificial intelligence, data centers, chips, logistics, and everything else required to keep the machine moving. Its trailing free cash flow has been squeezed because property and equipment spending jumped hard, especially around AI. So the real Amazon question is not, did they beat? They did. The real question is, will this spending turn into future cash flow, or is Amazon entering a period where the business grows beautifully but the cash gets eaten by infrastructure? That is the tension. Now, Microsoft is probably the cleanest example of a company that can do almost everything right and still face investor pressure. Revenue grew in the high teens. Operating income grew around 20%. Microsoft Cloud remained enormous. Azure and other cloud services grew around 40%. For a company this size, that is almost ridiculous. But again, the market does not grade Microsoft like a normal company. Microsoft has become the default operating system for corporate work. Documents, spreadsheets, email, Teams, security, cloud, developer tools, workflow, enterprise software. It is everywhere. And when a product is everywhere, pricing power becomes real. You raise prices a little, bundle a little more, add Copilot here, add security there, and suddenly the revenue base moves higher without customers casually walking away. That is the beauty of Microsoft. But the AI side is more complicated. The company is spending heavily to support demand. And official performance details show cloud margin pressure from AI infrastructure and growing AI usage. That is the cost of the future arriving early. Servers, GPUs, power, cooling, networking, data, talent, research. None of that is cheap. So when investors see Azure growth, they like it. When they see margin pressure, they pause. And when they see the broader AI race becoming more capital intensive every quarter, they ask the same question again. When does this spending become operating leverage? Not a slogan, not a conference call sentence, actual leverage. Now, to be fair, Microsoft has something most companies do not have. It can spread AI across an existing empire, Copilot can live inside Office, AI can enhance Azure, GitHub can become more valuable, security can become smarter, search can improve. The company does not need to create a brand new customer relationship every time. It can upgrade the ones it already has. That is powerful. But it still needs to prove the economics at scale. Because AI revenue with weak margins is exciting for headlines, not necessarily for shareholders. AI revenue with expanding margins is a different beast. That is what investors are waiting to see. Now, Alphabet. This one surprised a lot of people. Because for a long time, the market treated Alphabet like the mega cap that might get disrupted first. The fear was simple. If AI answers questions directly, what happens to search? If users stop clicking traditional results, what happens to ads? If search behavior changes, what happens to the business model that built the empire? Fair questions. But the latest numbers did not look like a company getting run over. Alphabet revenue grew in the low 20s to roughly $110 billion. Google services grew in the mid-teens. Search and other revenue grew in the high teens. YouTube ads grew in the low double digits. Subscriptions, platforms, and devices also grew in the high teens. And Google Cloud was the standout. It grew in the low 60s to around $20 billion. That is a statement. It does not mean Alphabet has no risks. It does not mean AI will not change search. It definitely does not mean investors should ignore regulatory pressure. But it does mean the bear case has to become more serious than AI will kill Google. Because right now, search is still growing, cloud is accelerating, subscriptions are scaling, and AI usage is being pushed across the stack. Even Waymo is becoming harder to dismiss. The autonomous ride business is now doing well over a few 100,000 rides a week. That does not make it the next core profit engine tomorrow morning, but it shows that Alphabet has optionality outside the advertising box. And optionality matters when the core business is still strong. Here is the counterpoint, though. Alphabet also had a large other income gain connected to equity investments. So just like Amazon, you cannot blindly take the EPS number and extrapolate it like it is all recurring operating profit. Quality of earnings matters. This is why I keep saying the headline is only the door. You still have to walk into the room. There is one more layer here, and it matters for every one of these companies. AI is not like the last software cycle, where a company could build the product once and sell another copy at almost no extra cost. This wave requires physical capacity. Data centers, power contracts, specialized chips, networking equipment, cooling systems, and huge engineering teams. That means the winners may still win, but the path to those profits can be messier than investors hoped. And that is why the market is becoming more selective. A year or two ago, saying AI was enough to get applause. Now investors want evidence. They want cloud backlog turning into revenue. They want copilots turning into paid seats. They want better ad targeting turning into higher prices. They want search AI to protect, not cannibalize, the most profitable business on the internet. And they want free cash flow after the spending. That last part is where a lot of people get confused. Earnings can look great while cash flow gets pressured. A company can say profit is rising, but if capex rises even faster, the money left for buybacks, dividends, and balance sheet flexibility can shrink. That does not mean the company is bad. It means the investment case depends on future payoff, not just today's income statement. So when you hear huge growth, ask what it cost. When you hear huge capex, ask whether it is offensive or defensive. When you hear AI adoption, ask whether customers are paying real money or just testing tools. And when you hear a stock dropped after a strong report, do not assume the market is crazy. Sometimes the market is looking at the second page while everyone else is celebrating the first headline. That is the mindset you need right now. It sounds simple, but it changes everything when the numbers get this large and fast. Now Meta. This is the one everybody wants to talk about because Meta had the biggest emotional reaction. The company reported very strong revenue growth. Revenue came in a little above $56 billion, up in the low 30s from last year. Family daily active people were around 3.5 billion, up modestly year over year. Ad impressions grew in the high teens. Average price per ad rose in the low double digits. That is a powerful advertising machine. Think about what that means. Meta showed more ads and charged more for them. That combination is exactly what you want from a scaled ad platform. It means engagement, targeting, demand, and pricing are all working together. And yet the stock dropped after hours. Why? Because investors looked past the revenue line and stared at the spending line. Capital expenditures were almost $20 billion for the quarter. Full-year capex guidance moved higher into a range that sits roughly between $125 billion and $145 billion. That is an enormous number. And the company said the increase reflects higher component pricing and additional data center costs for future capacity. That is the AI race in one sentence. More demand, more infrastructure, more cost, more uncertainty about returns. Now, some investors will say this is exactly what Meta should be doing. And they have a point. If AI improves the feed, improves recommendations, improves ad targeting, improves business messaging, improves creator tools, and builds new consumer products, then this spending could become a massive advantage. But another investor will say, hold on. We have seen Meta spend aggressively on big future visions before, and shareholders did not always enjoy the ride. And that investor also has a point. This is why the answer is not obvious. Meta is one of the best businesses in the world. Instagram, Facebook, WhatsApp, Messenger, Reels, ad tools, business messaging, AI recommendations. The scale is almost impossible to replicate. If you handed a competitor a few $100 billion and said, go build Meta again, I am not sure they could do it. But a great business can still be an average investment if you pay too much or if future cash flow gets consumed by spending. So the key meta question is not, is the company strong? Yes. The key question is, how much of this capex is growth investment, and how much is the new cost of staying relevant? That distinction is everything. Growth capex builds a bigger future. Maintenance capex protects the present. AI makes that line blurry. A data center might power future products, but it also might just be what you need so your current products do not fall behind. And if everyone in big tech is forced to spend more just to keep pace, then some of the AI boom could become an arms race where customers benefit before shareholders do. That is the skeptical view, and investors should not ignore it. Now, I'm not saying Meta is in trouble. Actually, the operating numbers argue the opposite. The ad business is strong, engagement is massive, and revenue growth at this scale is impressive. Expenses did rise faster than revenue, but not in some wild, uncontrolled way. Free cash flow was still meaningful for the quarter. But valuation is the final filter. Do not look at one quarter and assume low 30s revenue growth continues for a decade. That is how people build fantasy spreadsheets. Large companies can grow quickly for periods of time, but gravity eventually shows up. The realistic question is whether Meta can compound at a strong double-digit pace while keeping margins attractive and converting AI spending into better monetization. If yes, the stock can still make sense. If no, the market may keep pushing back every time capex guidance rises. This is also why the after-hours drop is not automatically a buying signal. Lower prices help. Of course they do. But a falling stock is only an opportunity if the value is higher than the price. Sometimes it is. Sometimes the market is correctly lowering expectations. So what do we do with all four? Amazon is about whether AWS and AI infrastructure can turn today's spending into tomorrow's free cash flow. Microsoft is about whether Azure, Copilot, and cloud demand can create margin expansion after the investment wave. Alphabet is about whether search can adapt to AI while cloud becomes a real second engine. Meta is about whether aggressive AI capex strengthens the ad empire or reduces the cash shareholders thought they owned. That is the whole earnings season in one sentence. If you're successful, share your success story in the comments so others can stay motivated. And please remember this: great companies are not rare in mega cap tech. Attractive prices are rare. That is the game. Everyone knows these businesses are powerful. Everyone knows AI matters. Everyone knows cloud demand is real. The question is whether the future is already inside the stock price. So do not chase the first candle. Do not panic because a great company drops. Do not assume a green reaction means the stock is safe. Read the operating results. Look at cash flow. Watch capex. Separate recurring profit from one-time gains. And then ask yourself the boring question that actually makes money. What return do I need and what price gives me a margin of safety? That is investing. This video is for education and research only. I am not your financial advisor, and I am not telling you to buy or sell any stock. Use this as one piece of your own process. Check the filings yourself, and make decisions based on your risk, your time horizon, and your own financial life.